Hello everyone, this is Professor Kent. Today's recording is Chapter 1 Managerial Accounting and the Business Environment. So, this is the first chapter. Again, this is the Managerial Accounting. When we talk about when we start the any course, the first two chapters are a theory. So the first chapter is a theory. So the first we're going to be after we finish this chapter, we should be able to learn these objectives that are assigned to us after this chapter. When we talk about this chapter, managerial accounting and the business environment, first we talk about is what is the work of management. So of course every organization has managers, and what they do is they perform several activities. The first one they perform is planning, second one they do controlling, third one is directing, motivating, and the fourth one is they are the decision makers. When we talk about the first one, planning, so what do we mean by planning? What do they do? What managers do when it comes to planning? What they do is they identify the alternative. Then we have two alternatives: do we accept the project or do we reject the project? So once we select the project, then this what they do is select the alternative. So once we selected the project, that does the best job for furthering organization objective. If it's not going to further our organization, we're not going to go with this alternatives. And then we also managers also develop budgets to guide progress towards selected alternatives. The second the second um, the second activity that the manager perform is called directing, or second or third, doesn't matter. There's four activities: directing and motivating. Manager's job is to manage the day-to-day activities. Why they need to do it? So the organization is running smoothly. And how do they do that? They assign employees assignments. They assign what they're supposed to do. What they do is they problem solve. If there's a problem comes, it's their job to solve that problem. If the two employees has problems between each other, they resolve those conflicts, and they also provide an effective communication to all the employees. The other one is controlling. So why they need to controlling function, and why they have to do it? Because to ensure that the plans are being followed. So of course and that the planning, they know what needs to be done first, what needs to be done second, third, fourth, fifth. So they ensure everything is followed the way it's supposed to be done. They also provide feedback in a form of performance reports. And then what they do is they compare the actual budget with the actual budget with the budget are that compares actual budget with the budget that are essential part of the control function. And what do we mean by they compare? We budget it before we start the project. We budget how much it's gonna cost us, and then we look at we compare to the actual. When we compare these two, that whose job is that to do? Manager's job to do. Then the next one is decision making. The most basic managerial skills is the ability to make intelligent, data driven decisions. So we have a data, and we look at the data, and we make the intelligent decision. Whose job to do that? The manager's job to do that. Many of the decisions revolve around the following three questions. Now the decision making activity that the manager has to do is, what should we sell? So they are going to be deciding what should they be selling, and who should be serving it to, and how should we execute if they are going to be doing it. Now when we talk about data, of course data we collect, right? This is how we make better decisions in the future. Companies are now making decisions using analytical approach that employs extensive amount of data from a variety of sources. So the data will come from variety of sources. So It is estimated that less than 0.5 of the available data is currently being analyzed and used to support decision making. This suggests the business manager have the opportunity to harness the big data. So what we do is we collect the data. That data is being used to make a decision. So then there's two type of a data. Of course, when you collect a data, there's a large collection of data. When we think of where do we get that data from the inside and from the outside. Inside, the employees will tell you what went right, what went wrong. Outside is maybe other companies that are using this data or this product. This What does this data provide? So it provides opportunities for ongoing reporting and analysis. So then when we talk about big data, there's two type of data. One is structures, the other one is unstructured. Structures comes into memos and reports. Unstructures comes in the form of videos, pictures and audios. Going with big data, next is that and when we're discussing big data, we have five V's. The first three is variety of a data, volume, and velocity. So then when we go into variety means that data the refers to the data format in which information is stored. Now volume is the quantity of the data, and velocity speaks about the rate at which data are received and acted on by the organization. So it's the rate, velocity is the rate. The other two fives are the value and veracity. When we talk about value, means time, value and money. If you have a dollar today, is worth more today than it's worth in the future. What does that mean? If somebody gives you a dollar, you could buy another product that you need, or you can invest that dollar and then earn interest. So we always think dollar invested today is more than the value of the dollar in the future. Then talking about the next is veracity. Refers to what? User It refers to the fact that the user expect their data to be accurate and trustworthy. So we should be able to trust the data that comes in our way. From the management and accounting professional, veracity may be the most important five. So veracity is the most important one. But why is it? Because whatever we produce, our reporting, that reporting that we do, somebody's decision is impacted by this reporting. So saying that because their analysis and opinion, which are relied on by the stakeholder, must be supported by verifiable data. Means the data has to be verified in order to go into a report, so the so the stakeholder can make the decisions. Then we're going to go further. We are talking about data analytic. How do we analyze this data? When we think of it, analytic refers to the process of analyzing the data with the aid of specialized systems. So we have to use, when we have it, sometimes we use Excel, sometimes we use other data programs to draw conclusion on the information that they contain. Manager often communicate the finding from this data through the use of data visualization. We learn better by visualizing the data. So the visualization can come through graphs, come from charts, maps, or diagrams. Going further in our data analytic can be used for descriptive, diagnostic, predictive, and prospective purposes. So when we do that, when we talk about descriptive is what happened. Then the diagnosis, why did that happen? Predictive is what will happen. So we predict what's going to happen in the future. Perceptive means that what should we do? The data we have, what should we do with that data? Then going further, this is the process. What we do is we have a short-term plan, and what we do is we implement them. then we measure the performance, then we compare the actual with the budgeted, and then we go start again. This is a cycle. So this is a decision making cycle. Starts with planning, then we direct and motivate, then we control it, then after controlling it, we compare it. Once we compare it, we start with a planning with a new project again. Next, what we have is strategy part one. What is it? What is our game plan? Our game plan, what does it do? It enables the company to attract customers by distinctly itself from the competitor. How we are better, how our product is better than our competitor. The focal point of company strategy should be the target customer, what our target customer wants. And then what we have is we have the customer value propositions are the essence of our strategy. Now, when we're talking about strategy, value proportionate typically focus on providing customer with one-to-one following. When we talk about that, we talk about product and a service. So what we're doing is we're producing a product, or we'll be providing a service. Our product will be a low cost. Our service will be the customer should be able to be rely on our rely on our our service. Going now, this whole topic is financial accounting and managerial accounting. Up to now, you have learned financial accounting. In this chapter, we're going to be learning about managerial accounting. There's a difference between the both. The comparison, this chart will give you comparison of the both. When we think of it, who is the users of financial accounting? The external users, external persons who make financial decision. Either they're giving you a loan or they're investing into the company. The manager accounting, who are the users of a managerial accounting? The managers who are internally working for the company, and they control they who plan for and control an organization. Time is when the financial accounting is known as a historical, means there everything is recorded at the cost. And when we think of a managerial accounting, we're thinking of forecasting. So we're thinking of a future. So when you forecast for the future. The information that we produce in our financial accounting is verifiable versus the relevance. This information that we have, somebody else looks at our financial statement, they should be able to verify it. And then from the managerial, they look at a relevance for them to make the decision. Then we have a precision versus timelines. The precision for the financial accounting is a precision, where managerial accounting is timeline. If we take 2 years to do this project, that's the timeline they look at it. The subject is primary focus is on a company-wide reports. There's no different reports for internal and external users, where in managerial accounting, they focus on the segment is you could have a one department, or you could have two, three, four. Each department is a segment. Then the rules, do we follow the rules? Of course, if we follow a GAAP principle, we follow an ASPE standards or an IFRS. But then when you do produce anything under the managerial accounting, they are not bound by any rules or regulation. The requirement is mandatory. It's mandatory for us to produce financial statement. It is not mandatory for us to produce any managerial accounting statements. Going further, managerial accounting, a business process. What is a managerial accounting? It is a series of steps that are followed in order to carry out some tasks in the business. A value chain consists of a major business function that add value to the company. So managerial accounting, what they do is it add values to the company's product and service. When you think of a product, we say we research a product and we develop it, and then we design a product. Once we design it, we manufacture it, then we market this product. After marketing it, we distribute it to the customers, and then what we do is if they're not happy, we provide them with a customer service. The next we're looking for is enterprises risk management. Any business, any enterprise, there is always going to be a risk. So every business strategy or decision involves a risk. There's a enterprise risk management is a purpose is a process used to proactively identify and manage this. We anytime we know there's a risk, we wanted to eliminate or mitigate that risk. Companies, what they should do is the company should identify the risk before it happens. So they identify it before it occurs. It reduces the risk by implementing controls. So you know if there's a control, you're going to implement some controls to mitigate this risk. Now, these are some examples of your risk management. So, what happens is these are some of the examples of a business risk, and these are some example of a control risk. How do we control to reduce this risk? First off is product harming customers. Example is a risk. If a product that is harming, then we're looking for a lawsuit in the future. How do we do that? What we do is we create a new product, a new program that tests the product so that before it goes to the customers, we can test the products before it goes to the customer. Losing market share due to unfrozen action of the competitors. So what happens is that we have a competitors, they are doing better than us. That's an example of a business risk. How are we going to do it? We're going to legally gather the information about the competitors' plan and practice. So what we do is we could gather some information, what legal information about our competitor and their plans and practice, so we can beat them on their own game. Now, poor weather conditions shifting down the operation. So now we live in Canada. If, for example, if we have a lot of snow, we're unable to deliver the product. Those are poor weather conditions. So what happens is that we should have a contingency plan. So what we do is if it's going to, we know the weather forecast, we know that it's going to snow tomorrow. So what we could do is we could deliver our product day earlier. So that's called a contingency plan. Website malfunction. So we have a virus on our website. What we can do is we can go through, test that the website before going live on the internet. We can test it so that before it goes live, everything is taken care of. A supplier strike halting the flow of raw material. We need a material to produce a product, and we have a supplier there that they're going to go on strike. So how we're going to do is what you're going to do is establish a relationship with two companies capable of providing the raw material. So if we don't get it from this suppliers, we should have another employer we should have another employer that we can use them while this supplier is on a strike. Financial statement unfairly reporting the value of the inventory. So at the end of the year, what we do a physical count of our inventory. We want to make sure our accounting records are same, so the financial reportings are done fairly. An employee accessing unauthorized information. What happens is we have an employees, each supervisor have a different authorization, employees has a different authorization. So what we should do is we should create password so that prohibits other people from using the information. If supervisor should the manager shouldn't be looking at CEO's information, and the employee shouldn't be looking at the manager's information. We talk about ethics. Ethics are very important. Confidentiality, confidentiality is essential because of the importance of information they analyze. We need to keep everything confidence. Integrity is maintained by avoiding conflicts of the interest with their employees or clients by communicating the limits of professional competence and not accepting favors. So integrity is we shouldn't be taking any favors. So you be shouldn't be accepting any favors that can compromise the information or compromise your decision. Objectivity is must be present in communication so the recipients can receive a favorable and unfavorable information. So we shouldn't, when we're providing information, everybody should have the same information. When we talk about our as a company, we have a social responsibility. So who we have a social responsibility to our stakeholders. So who are the stakeholders? Stakeholders are customers, our employees, suppliers, our community that we are practicing, and our shareholders who share the profit with us, and any other advocates that are out there. So that's our social responsibility. When we talk about leadership, leadership is leaders must be available to unite the behavior of employees around two common themes: pursuing strategic strategic goal and making optimal decisions. So what we have is we have a goals, and those goals are making optimal decisions. There's two therefore intrinsic motivation and extrinsic incentives are 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 needed to be understand to influence our human behavior. So that what in there's two type of motivation: intrinsic and extrinsic. Now intrinsic is within us, so it's within us. Extrinsic incentives are they come from outside, a way to highlight important goals and to motivate employees to achieve them by offering them rewards. So if we say we provide a salespeople are provided a commission, so that's an extrinsic incentive. And some people don't have a commission, but they do well regardless of it. Now the next one is cognitive biases. What does that does? Everyone poses cognitive biases. What does um, or a distorted thoughts process? It is important for leaders to recognize this. So leaders, who are the leaders in the company, within the company, in this case we're talking about managerial accounting. So managers are the leaders, so they needed to recognize if they anybody poses a cognitive cognitive sorry cognitive biases opinion. When we think of managerial accounting, so what are the managerial accounting? What it does is it's a summary of it, assess managers with carrying out their responsibility. There's to that includes planning, directing, motivating, controlling, and decision making. Managerial accounting differs from financial accounting. Financial accounting, we provide information to the outsider world, where managerial accounting, we do accounting for the inside of our company. Going further, we have a enterprises risk management involves what what we have to do is we have to proactively identify and manage the key risks. And once we have the key risks, then we needed to find a different way to reduce those risks. Then what have is professional accounting organization have their own code of ethics to provide the guidance for members regardless of their place in the employment. It doesn't matter if they are CPA or not CPA. They should professional accounting organization, they have to provide uh, they have their own code of professional ethics that they have to follow. So we also going to go to many companies have embraced corporate social responsibility, whereby the need of various stakeholders are considered making decisions. Stakeholders are the who has something to lose within the company. Could be employees, could be managers, could be anybody who had some stake in the business. It is important for management accountant to understand how behavior is influenced by there's two motivations. Intrinsic is within us. Extrinsic is comes from the outside world, which looking at any data that we have. Thank you so much for listening to me. This was, I know it's a theory, but when we go to chapter 2 is more of a hands on than a theory. But theory is sometimes important to learn the material. Thank you so much for listening to me. Take care and bye for now.